Hello and welcome to Insurance in Canada. I'm your host, Rick Pedeta. Thank you so much for joining me. On today's episode, we're looking at three articles. The first article looks at a recent tribunal case in Ontario that dealt with a person who was catastrophically injured in an automobile accident who decided to move from one location to another, move his residence. The second one looks at would rising construction costs be risking yourself being underinsured. And our last article will be looking at issues that insurance companies in China are facing regarding insuring electric vehicles. So without further ado, let's take a look at insurance in the news. So our first article today looks at a case involving a person, Ontario resident, who was injured in an automobile accident, who decided to move within 3 years of the accident. Now, the automobile policy in Ontario does cover certain expenses related to accident benefits and home modifications. So every automobile policy that has accident benefits is going to have medical rehabilitation and attendant care benefits. And under rehabilitation, one of the expenses that can be covered is modification to a claimant's home to adapt to their injuries that are long-term injuries. So, but not all expenses would be covered. There are certain restrictions, and this particular tribunal case that we're going to look at looks at a situation where somebody who was injured in an automobile accident decides to move after 3 years, and whether those expenses to modify his new home would be covered under the automobile policy. So to the article, a badly injured driver moves 3 years after his crash. Must the auto insurer retrofit his new home? An Ontario tribunal decision opens to the door to this possibility, even though it finds against the catastrophically impaired driver in this case. And before we progress any further, under your automobile policy, Ontario automobile policy, your injuries can be classified in one of several categories. The most lowest tier injury is the minor injury. Minor injuries are such things as scrapes, bruises, whiplash. Those are considered minor injuries, and those types of injuries would have a lower limit available to it regarding medical expenses. After that is non-catastrophic injuries. Non-catastrophic injuries are more serious than minor injuries. However, it's not specifically defined. It's defined as any injury that's not a minor injury or a catastrophic injury. Catastrophic injuries are the most serious types of injuries. These are going to be life-altering type of injuries. However, it is defined in the statutory accident benefits schedule what qualifies as a catastrophic injury. So there's some quite serious injuries you could suffer in an automobile accident that may not qualify for catastrophic injuries. But in this case, for this claimant under their policy, they were determined to be catastrophically injured. Therefore, they'd have much higher limits available when it comes to medical rehabilitation and attendant care expenses. He would have at least $1 million available to for in his policy. However, I don't know if he purchased any optional accident benefits regarding medical rehabilitation and attendant care. So let's take a look at this particular case. Auto insurers could theoretically be on the hook to retrofit houses for catastrophically impaired drivers who move into new homes years after their accidents, a recent Ontario tribunal decision suggests. But if that happens, they may not have to pay more than what it would cost to retrofit their pre-accident houses, and the injured drivers would have to prove exactly how each of the proposed renovations in a treatment plan would benefit. In Orme versus TD General Insurance Company, Ontario's licensed appeal tribunal dealt with a complicated case involving a catastrophically injured driver who moved to a new province 3 years after his crash, but only a week after his catastrophic impairment designation. Kevin Orme wanted his auto insurer TD General Insurance Company to pick up the estimated $722,117 tab to retrofit his new home in Prince Edward Island based on recommendations made in a treatment plan prepared by Accessible Daily Living in September 2023. Orme was injured in an auto accident on May 29, 2018. At the time of the accident, he was living in an Ontario farmhouse and renting his pre-accident home. His injuries included a traumatic brain injury resulting in memory issues, cognitive challenges, light sensitivity, and hypersensitive hearing. In addition, he had chronic back pain, limited use of his left arm, wrist, and hand, nerve damage in his legs, and depression, anxiety, and sleep disorders. So I'm guessing that his pre-accident home was not fit for him to live in, considering the injuries that he sustained. So I'm guessing that's why he moved into the Ontario farmhouse, but still apparently kept his pre-accident home. Back to the article, he was deemed catastrophically impaired on June 23rd, 2021. So that's almost 3 years after the accident. It was a little over 3 years after the accident that he was actually deemed catastrophically impaired. So receiving that designation doesn't necessarily happen at the time of the accident. Sometimes it'll take it could take some time to actually for those injuries to manifest themselves to a state where somebody could be considered catastrophically injured. It may not present itself right at the time of the accident or shortly thereafter. So it is possible to receive that designation and have the higher limits available to you, although 3 years seems quite a long time, but it's not unheard of. 1 week later, after the catastrophic impairment designation, he moved out of his Ontario home to a new home in PEI. He had been evicted from his prior residence due to financial constraints and complications arising from the COVID-19 pandemic, the LAT decision notes. The relocation was driven by a desire to maintain a lifestyle involving hobby farming and caring for animals, LAT adjudicator Melanie Malak notes. Orme submits that the PI home was affordable but requires modifications to address his accessibility needs and to prevent further deterioration of his physical and mental health. Orme submitted a treatment plan to TD in January 2023 requesting a home assessment of the applicant's PEI home. Recommendations for retrofitting the PEI home include main floor bedroom to avoid stairs and reduce pain, an accessible kitchen with customized counters, ADA compliant appliances and ergonomic storage, a relocated wood-burning furnace to an attached garage to eliminate heavy lifting. A relocated wood-burning furnace to an attached garage, okay. Radiant heating to alleviate muscle and joint pain. A therapy room to support in-home rehabilitation. Safe and uniform entry-exit systems with vertical platform lifts and level walkways. Accessibility-focused flooring, lighting, security, and energy-efficient systems. TD Insurance denied the claim. Orme asked his insurer to consider an alternative assessment of the home where he lived in Ontario at the time of the accident. TD agreed to an assessment of the pre-accident home. An assessment report for both the pre-accident Ontario home and the PEI home was submitted to the insurer in 2023. Within a week, the insurer again denied the claim in its denial letter to Orme. The insurer states, "You made the decision to purchase a new home outside of Ontario knowing that an excessive amount of upgrading and home modifications, including pre-existing hidden damage, may exist on the property, yet you made the decision to purchase the property." So, yeah, that's going to be a bit of an issue because the automobile insurance policy is there to pay for upgrades to make the home more accessible to somebody who suffers the injury, not to deal with maintenance issues that have been ignored. So I'm not sure what pre-existing hidden damage on the property that they are referring to, but let's say that the roof is in poor condition and needs to be replaced. Well, that's not something the insurance company, the auto insurance company, would be upgrading as part of the accessibility plan, because that doesn't really have anything to do with making the house more accessible. It's just maintenance issues. Back to the article. At the tribunal, the insurer described the renovations contained in the treatment plan for the PEI home as a wish list of every possible home modification that the report's authors believes could benefit the applicant. For his part, Orme denied the recommended upgrades were excessive. He argued before the tribunal that the accessibility issues in the PEI home mirror those experienced in his prior residence and likely most any home. Furthermore, he argued the proposed renovations were essential to ensure his safety in his home, improve his quality of life, reduce pain, and enable him to contribute meaningfully to his family and property, the LAT decision says. First off, the LAT said TD Insurance couldn't refuse to retrofit Orme's PEI home simply because he had moved 3 years after the accident, and that is correct. There's nothing in the statutory accident benefits schedule that says that the home that needs to be retrofitted has to be in Ontario. Back to the article. While I accept TD's insurance argument that Orme did not claim entitlement to home modifications until several years after the accident, there is nothing in the statutory accident benefit schedule that confines the period of eligibility to home modifications for an insured who suffers a CAT impairment. Malak ruled. Section 20, paragraph 2, subparagraph A of the schedule expressly removes the usual 260-week post-accident limitation period for rehabilitation benefit claims when the insured is CAT impaired. Second, Orme provided assessments for both the Ontario pre-accident and PEI homes the LAT found. I find Orme is not preventing from claiming entitlement to home modifications just because he no longer lives at the Ontario home, Malak wrote. I find that Orme is entitled to the value of the home modifications that are found reasonable and necessary to the Ontario home when compared to the PEI home. I find that Orme is not entitled to renovations to the PEI home in excess of the values of the renovations needed to the Ontario home to accommodate Orme's needs. I find that a comparison must be made of the two properties to ensure that the applicant is not receiving a windfall. At this point, the LAT ruled Orme did not prove the renovations listed in the treatment plan were reasonable and necessary. It is Orme's onus to prove entitlement, and the tribunal cannot make a case for him by connecting the dots between the treatment plan's renovation recommendations and the medical evidence of disability to show those modifications will reduce or eliminate the effects of the applicant's disability, Malak wrote. So, yeah. So the decision comes down that while the claimant is entitled to the home modifications, it's not surprising that he didn't claim the home modifications until after the designation of being catastrophically impaired. I'm not surprised to see that because before he was designated as being catastrophically impaired, that means he would only have access to the non-catastrophic limit, which probably would have been the minimum of 65,000 unless he purchased an optional limit. But if he didn't, he only would have had 65,000, which wouldn't have been enough to cover all his medical costs that isn't covered by OHIP, as well as the home modifications. So yeah, I'm not too surprised to see that this didn't come up until after that designation, because those extra funds are available that he would be able to make that claim for the home modifications. But yeah, what the tribunal also said is the value of those home modifications cannot exceed what it would have cost to modify his Ontario home. So it's quite possible that the modifications in the PEI home could be higher just because it's in PEI. It states in the article that Orme wanted to move to the PEI because of the lower cost. However, the modifications they're asking for the house, we don't know where in PEI the house is located, so it could have been located far from where any contractor, any local contractor, maybe no local contractor, would be able to make these modifications. So maybe somebody out of province would have had to come in to do these modifications, which would increase the costs. I'm just speculating here, but that's one thing that these claimants would have to keep in mind when it comes to considering moving out of the province to live a different lifestyle, or whatever reason. So that's the decision coming down from the tribunal, which in my opinion seems fair. But let me know if you've ever experienced this sort of situation, if you might have a different opinion or a different maybe your case was slightly different and a different outcome. So just let me know down in the comments. Next article looks at rising construction costs, and they have been rising quite a bit over the last 6-7 years, and how that could leave some people underinsured because they're not keeping their limits up with the modern building costs. Rising construction costs could leave properties underinsured. Several factors, including ongoing COVID-19 related inflationary effects, tariffs, the industrial carbon tax, and stricter building codes have converged to push construction costs to new highs. When combined, these factors materially impact insured values, panelists tell a session at last week's RIMS Canada conference in Calgary. I had a client that was slated to build a multi-use commercial retail strip mall, said Devin Baker, manager of business development at Suncorp Valuations. It was a large-scale 50,000 square foot property, and they got a quote from a reputable contractor to build this in Regina at $12.5 million in 2024. The client decided to pause the project for the year. They got a revised quote, which came in 2025 at $14.3 million for the exact same specification, says Baker. The main driver that the construction contractor provided the client was, well, there's been a year of inflation, there's economic uncertainty, it's harder for me to get my staff, and I have to pay my staff more. It's a real-world example of construction cost hardening, says Baker during the panel discussion, yet strategies exist for organizations to ensure appropriate insurance coverage amid ongoing cost uncertainty. COVID-19 caused extensive surge pricing, supply chain delays, and increased demand for construction materials. These pandemic effects never fully receded, explains Vic Persaud, manager of business development at Suncorp Valuations. We saw a construction materials spike in 2021 and 2022, almost up 20% to 40%, he said. We saw lumber peak at over 1,600 US per 1,000 feet of board, from almost 550 pre-pandemic, which was a significant increase. Unfortunately, today we have not seen a complete retraction in costs. We have seen year-over-year increases are significantly less, but we have gone to a state where costs have come down significantly. Other adverse COVID-19 remnants include construction labor shortages, which vary depending on profession and province, but remain elevated. Builders, for example, report a near 20% shortage of carpenters, along with 22% for welders and 18% for plumbers. Ongoing tariffs are causing significantly increased construction material costs. In March 2025, the U.S. implemented 25% tariffs on Canadian steel and aluminum, setting off an ongoing trade war. In June, the U.S. raised steel and aluminum tariffs to 50% and set tariffs at 35% on Canadian softwood lumber. Tariffs function as a cost multiplier. The 6-month period here where we've seen these tariffs has contributed to an estimated 8 to 12% increase in total project costs, depending on the material mix. For example, who says a hospital expansion requiring 8,000 tons of steel would see an additional 20 million Canadian under the 25% tariffs. While Prime Minister Mark Carney dropped the residential carbon tax earlier this year, the industrial carbon tax remains in effect. This carbon pricing regime, though, has a material impact on construction costs. And what's a manufacturer going to do when they incur a tax or a tariff or an increase in costs? They pass that along. In terms of the cost of the materials, said Baker, in 2025, the impact on building costs is estimated to be around 3%, he said, by 2030. That cost will rise to 6%. The 2025 carbon price is $80 per ton of carbon dioxide. Construction, which uses cement, adds about 1 to 2% to the overall building cost. And steel and manufacturing material adds roughly 0.5 to 1.5%, he said. So tariffs, for those of you who are looking to build a commercial building, build a house, may or may not affect you. However, such things as industrial carbon tax is definitely going to. The material that you're going to be using in building may or may not come from outside of Canada, but for the vast majority of the materials that is coming from Canada, yeah, that's going to be hit by that carbon tax. So may not be able to do anything about terrorists, but the federal government definitely could do something about that industrial carbon tax to help bring down building costs. But Whether anything gets done or not, who knows? Uh, Back to the article, National Building Code of Canada, adapted by each province and territory to align with regional needs, requires all new construction projects to meet minimum thresholds. The codes are getting stricter for two reasons, says Baker. One, Canada's got a net zero goal by 2050. One of the government's ways of incentivizing net zero is to make our construction of properties and new buildings greener, better insulated, use less utilities, and be just all around a greener type of property. A second focus is resiliency. We're building our properties to either be seismically stronger, to be more flood resistant, to be more fire resistant, and in certain regions in Canada, to be more earthquake resilient. Those upgrades, though important, are costly overall. If we take some of the enhancements to the building codes, we add about 8% to 10% in terms of our construction costs. With construction costs reaching record levels, getting accurate property valuations is critical for insureds, but there are a couple of ways to do it when establishing value with a credible starting point, i.e. a prior valuation. Baker advises the first thing I would do is confirm this time. Was it pre-2019 before all these increases? Maybe your last valuation was 2023, or you built it 2023. Consider the time. A 5-year-old valuation is a really old valuation in today's market, which is true, but it's going to depend on what we're talking about. If we're talking about a commercial building, yeah, keeping up with the construction cost is going to be critical, because what you have on your limit on your policy is the maximum that that policy is going to pay. There's some insurance companies that might offer endorsement to your policy, which could cover an inflation factor up to a certain amount, but still, if you're 30%, 40% underinsured, nothing's going to save you at that point. If we're talking on the personal line side, the homeowners type policy, those types of policies tend to have an endorsement called guaranteed replacement costs, and you find that not just in Ontario, but all provinces. In Canada, insurance companies on homeowners policies tend to offer guaranteed replacement costs. It will depend on the insurance companies. The insurance company that we're talking about, but like I said, most standard insurance companies do offer that with that endorsement on your policy, even though you may have a limit for the dwelling building on your policy. With guaranteed replacement cost, you will take comfort in knowing that even if it costs more to rebuild your house than the limit that's on the policy, the insurance company will pay whatever it costs in order to rebuild the house. So personalized type policies have that buffer, but commercial policies generally do not. So be forewarned, depending on what kind of property owner you are. If you're talking about your residence or you're talking about investment property, commercial property, reviewing those limits, keeping up to date, reviewing it annually, not just every 3 or 4 years, but reviewing it annually is critical, because you do not want to be underinsured and come claim time be out possibly hundreds of thousands of dollars or possibly millions of dollars because your property was underinsured. And our last article, I tend to focus on articles that deal with Canadian topics. However, every now and then I find a topic that, or find an article involving international situations that could affect Canada or could indicate for insurance companies in Canada where things might be going. And this is one of those cases. It involves insurers in China and how they are dealing with trying to insure electric vehicles. So let's take a look at this. China's EV boom saddles its auto insurers with chronic losses. China's giant electric vehicle insurance market is flailing. Losses are piling up as companies' risk models haven't kept up with changes in vehicle economics and driver behaviors. The country now has tens of millions of electric cars on its road, and sales are rising at a rapid clip. This is kind of what the federal government here in Canada is trying to mirror as well, for Canada to have all our vehicles electric. So it may not be as many vehicles, even percentage per capita, in Canada as China, but let's see how China is dealing with that. Chinese insurers have found that new energy vehicle owners, which excuse me, tend to be younger on average, are about twice as likely as owners of gasoline-powered cars to file claims. The repair costs are also significantly higher. But despite EV drivers paying anywhere from 20% higher to double the premiums for traditional cars, China's auto insurers have been nursing losses from covering new energy vehicles for at least 3 years. The industry lost 5.7 billion yuan, or 802 million, I imagine that's American, from underwriting new electric vehicle policies in 2024, according to data compiled by the China Association of Actuaries, and is on track to lose money again this year. The company's experience mirrors what insurers in other parts of the world are starting to grapple with, and the Chinese firm's difficulty turning a profit in the world's largest and most developed EV market shows the difficulty of pricing risk accurately. In China, some insurers are trying to discern which car owners are using their vehicles to provide ride-hailing services, which increases their likelihood of getting into accidents, and whether some models are riskier than others. The ride-hailing services, that's not just limited to electric vehicles. That's a concern insurance companies have to concern themselves with, regardless if we're talking about electric vehicles or internal combustion engine vehicles. So that particular aspect of the article, I don't think is fair to blame completely on the EV market, but other risk factors definitely. EVs accelerate faster than gasoline-powered cars, and their batteries that are usually located under the floor can be easily damaged if drivers go too fast over bumps. Their complicated battery systems also can compromise as much as a third of the car's value and have expensive or niche parts that aren't widely available. So that's something we see here in Canada, as well as issues that insurance companies in Canada regarding electric vehicles have experienced as well. Some ride-hailing drivers have categorized their vehicles as residential when applying for insurance to pay lower premiums, presenting a challenge for insurers. Historical data on car types and driving habits also becomes quickly outdated when new vehicle models are constantly being rolled out. The upshot is that insurers have not really managed to fully differentiate between different brands, different models, and different loss patterns to find a way to make a profit, said Qin Lu, CEO of Greater China at insurance broker Aon PLC. It's a very challenging area, added Lu, who predicts that many insurance companies won't be able to turn things around for at least another 3 years. I hazard to say that, 3 years or even ever. With EVs now overtaking gasoline cars and sales volume, a solution needs to be found, he said. We are just right now in the middle of it. The industry as a whole is trying to find its way to make it work. Insurance companies in China collected 141 billion yuan in premiums for covering electric vehicles last year, according to the Actuaries Association. Expectations are for them to reach 500 billion yuan in 2030 to make up more than a third of auto insurance market then. According to research from Bocom International Holdings, EV insurance pricing is still in a trial and error phase, says Wenwen Chen, an analyst for S&P Global Ratings, even as their premiums are set to be the future growth engine for auto insurers. Nicole Wu, a 38-year-old who works for a media firm in Hangzhou, said she bought an imported Tesla Model 3 in 2019 and had several accidents afterwards that required several accidents. Wow. Significant repairs. In one case, she said her insurer paid more than 70,000 yuan for the car's damage, in part because the vehicle could only be fixed at a Tesla Inc. body shop. That's another issue I've mentioned before in previous episodes about problems with trying to insure electric vehicles, that they can only be repaired at certain locations because not every body shop is prepared to repair damage to an electric vehicle. Over the years, her insurance premiums increased fourfold to almost 30,000 yuan annually. It's just horrifying, she said. Wu decided to opt for a plan that was about a fifth of the cost and provided mandatory liability insurance for traffic accidents with minimal third-party coverage. But then it really makes me anxious when I drove the car, she recounted. Wu said she ended up selling her Tesla last year and buying a cheaper electric car from Neo Inc. She now pays about 7,000 yuan for insurance from a company recommended by Neo, whose after-sales service can handle repairs. In China, the average EV insurance premium is about 4,487 yuan a year, according to data compiled by Aon. That's about a quarter of what EV owners pay in the US on average. New energy vehicles in China also significantly cost significantly less than in America. Their average price was 158,900 yuan in August, about 80% the price of hybrids and 90% that of fuel cars, according to Auto Home Research Institute. Over the past year, some Chinese insurers have hiked premiums or backed away from selling EV policies, leaving vehicle owners struggling to find affordable coverage. So far, there have been no discernible impact from costlier EV premiums on overall electric vehicles. And that's true. The vehicles may cost less in China, but then again, they wouldn't meet North American or Canadian or American safety standards, so they wouldn't even be able to be sold here. To address the issue, Chinese authorities in January launched a platform called Easy to Insure to connect EV owners with insurers. It has so far helped insure more than 500,000 vehicles with total coverage of about 494.8 billion yuan. That's great, but if you're not addressing the claim side of things, eventually those chickens are going to come home to roost for those insurance companies that these people were able to find insurance with. The platform doesn't guarantee that users get the lowest premium, but ensures applicants are not rejected, says Zhang Lei, Chief Executive Officer of Cheche Group, Inc., an insurtech company that developed it. Auto insurers can freely price policies in China. The authorities set base premiums depending on factors including vehicle type and usage. Companies can adjust those premiums up or down within a specific band based on drivers' risk policies. So that's interesting how auto insurance, I've always wondered how auto insurance works in China. So there's a very brief glimpse of how pricing works there. In January, Chinese authorities released a broad set of guidelines telling companies to lower the cost of replacement parts and repairs for new energy vehicles and promote cross-industry data sharing. And cooperators, insurers cannot refuse customers or deny them compulsory traffic insurance, they said. The insurance industry had an average combined ratio of 107% for new energy vehicles in 2024 versus 109% in 2023, according to official data. A combined ratio of over 100% reflects an underwriting loss, which means, for instance, for 107%, for every dollar in premiums that the insurance company collects, $1.07 is paid out in claims. So that's what the 107%, the combined ratio is talking about. So that's how that particular statistic works. It means companies are paying out more in claims expenses than they're collecting premiums. Many smaller insurers in China have struggled to profit even from traditional auto insurance because they lack scale and pricing power. So that's how things are going in China when it comes to electric vehicles, who've adopted the electric vehicle much more than we have in Canada. But it's a wake-up call to insurance companies in Canada that before it gets adopted any further, the use and purchase of automobiles, electric vehicles by the general public, these are issues that the insurance industry in Canada would have to look at and address before it becomes an issue here in Canada. And that is it for me for today. I want to thank you for joining me. If you like what I do here, please like this video. Please subscribe for more. Please follow Insurance in Canada on Twitter/X, and also look for audio episodes of Insurance in Canada on Spotify. So until next time, bye-bye.